Today, a January to forget. Hello again, it's Martin North from Digital Finance Analytics, one of his posts covering finance and property news with a distinctively Australian flavour. Well, world stock markets climbed higher on Monday as investors digested new optimism from the US Treasury's top economist that inflationary pressure should ease in 2022 due to weaker demand for goods, easing supply bottlenecks, and a receding coronavirus pandemic. In a statement released alongside the Treasury's quarterly borrowing estimates, Assistant Secretary for Economic Policy Ben Harris said he expects energy prices to stabilise in 2022, but geopolitical instability could push prices higher. Investors said the backdrop for equities remains uncertain as other central banks tighten policy. The Bank of England is expected to hike rates again on Thursday, and another jolt higher in oil prices added to inflationary worries. The Pan-European Stock 600 index, though, rose 0.72%. Lunar New Day holidays made for thin trading conditions in Asia. MSCI's broadest index of Asia-Pacific shares outside Japan closed 1.11% higher. And in the US, the S&P 500 racked up gains on the last day of trade in January, led by tech and consumer discretionary stocks as investors looked ahead to a busy week of quarterly earnings for big tech. The S&P 500 rose 1.9%, the Dow Jones Industrial Average added 1.2%, and the Nasdaq gained 3.4%. The major averages, however, ended January lower following a volatile trading month on fears the Federal Reserve is to step up the pace of rate hikes. Tesla closed more than 10% higher, building on gains from last week when the electric vehicle maker reported better than expected earnings, after Credit Suisse upgraded its outlook on stocks to buy from neutral, citing strong margins. Tesla has surprised to the upside on margins, in large part driven by cost reductions. We believe the strong margins are sustainable, Credit Suisse said in the note. Strong margins are critical not only for EPS, but also as we expect Tesla to eventually use its margin strength and software standardization to spur volume growth. Netflix jumped more than 11%, continued to make up ground after its recent plunge, after Citi upgraded the stock to buy from neutral, citing material subscriber growth prospects. The return of investor appetite for growth sectors of the market followed stellar earnings by big tech stocks last week, including Apple and Microsoft, that helped ease worries about an increasingly hawkish Federal Reserve. Fingers point to the Fed as a main instigator of last week's market turmoil, and our suspicion is that traders and investors will remain hypersensitive to any further developments on this front over the short run, Janie Montgomery Scott said. Cyclical sectors, including financials and energy, lagged the broader market, though the latter was supported by an ongoing melt-up in oil prices. Today, it is above all the concerns about supply outages in connection with the Ukraine crisis that keeps pushing prices further up, Commerzbank said in the note. The tech-heavy Nasdaq added 3.41%, but has borne the brunt of selling and is still down 40% from a record peak last year. Before Friday's rebound, the index had been headed for its worst January since the global financial crisis in 2008. It last gained 1.8%. This is not the classic sell-off affecting lower quality underperforming companies. This sell-off is driven not by fundamentals, but by the action of central banks at a time when growth is very strong, said Flavio Carpenzeo, investment director at Capital Group. For years, you were like a spoiled child. You could get all the money you wanted and for free, and you could buy whatever you wanted. You didn't care much about quality. Now it's the other way around. You have to be more disciplined, so you need to look carefully at valuation, he said. The standoff over Ukraine also remains a thorn in the market's side, with concerns a Russian invasion would cut vital gas supplies to Western Europe. Moscow denies, of course, any plans to invade. Oil prices ended January up 17% higher, in the biggest monthly gain in a year, boosted by a supply shortage and political tensions in Eastern Europe and the Middle East. West Texas Intermediate rose 1.5% to close at $88.15 a barrel. In economic news, data showed Eurozone economic growth slowed quarter on quarter in the last 3 months of 21 as expected, and data out on Sunday also showed that China's factory activity slowed in January as a resurgence of COVID-19 cases and tough lockdowns hit production and demand. Yields on US Treasuries that are most sensitive to inflation expectations hovered near their highest levels since February 2020 on Monday, capping a bond market sell-off this month that by some measures is the worst in 13 years. The yield on 10-year Treasury notes was up 0.9 basis points to 1.789, while the 2-year US Treasury yield, which typically moves in step with interest rate expectations, was up 0.5 basis points to 1.177. The bond market may have settled into a flattening yield curve, reflecting an outlook for several rate hikes over the course of this year, and then at least a pause as the economy adjusts, said Tim Grinsky, senior portfolio strategist at Ingalls and Snyder in New York. As well as the Bank of England, the European Central Bank meets this week, but is expected to stick to its argument that inflation will recede over time. Investors will eye big US data releases this week, including the ISM readings on manufacturing and services and the January jobs report. The headline US payrolls number is expected to be soft, given a surge in COVID-19 cases and adverse weather. The median forecast is for a rise of just 155,000, while forecasts range from a gain of 385,000 to a drop of 250,000, so nobody knows. The US dollar fell as investors consolidated gains ahead of the monthly employment report this week, taking a pause after a furious rally that took the currency to a 1.5-year high on Friday. The dollar index fell 0.46%, and the euro was up 0.89%, putting it on track for its largest daily fall since January the 12th. On the month, the greenback was up 1.4% after hawkish noises from Fed Chair Jerome Powell last week. A mix of consolidation and month-end position squaring has nudged the dollar off its highs, said Joe Manimbo, senior market analyst at Western Union Business Solutions in Washington. An events-filled week ahead threatens to keep market volatility high. The buck appears to have peaked for now, as Friday's job report is forecast to show another month of tepid hiring, he added. Australian shares edged lower after a choppy session on Monday, with the technology, property and consumer discretionary sectors leading gains ahead of the RBA's widely expected decision to end its stimulus that helped stocks reach record levels since the pandemic started. On Monday, the S&P ASX 200 eased 0.2% to 6,971 to post a 6.3% loss during January. That's the biggest monthly drop since COVID-19 first hit about 2 years ago. The index plunged as far as 6,758 last week, a level last seen in March. The biggest laggard of the session was medical protective suits maker Ansell, whose shares plummeted 14.3% to 26.76, the largest daily decline since 2016. Ansell had issued a profit downgrade blaming declining demand for single-use gloves and a margin crunch. The company was hit by a series of blows, with its production network suffering shutdowns. Malaysian authorities ordered a factory to stop operating for a week from January 27th as they seek to control a worsening COVID-19 outbreak. US border authorities blocked one of Ansell's large single-use glove supplies from shipping into the US because of labour practice issues. Meanwhile, freight costs ballooned and Ansell said customer demand slowed at a faster pace than expected. Logistics disruptions also led to further delays in orders. Shares in ARB jumped 7.9% to 46.15 after the car accessories maker reported strong demand for extra equipment for off-road vehicles and SUVs. ARB said its sales revenue rose 26.5% to $359 million in the 6 month ending December the 31st, adding it expects pre-tax profits to be between $90 million and $92 million. ARB is optimistic on the outlook, citing a strong customer order book and improved inventory levels, and the company also said it was facing ongoing delays in new vehicle availability. ARB releases its full first half results on February the 22nd. Shares in mining company IGO fell 0.8% to $11.75 after its first half earnings underwhelmed investors. IGO reported a more than 20% increase in revenue thanks to strong cash flow generation from its Nova operation. Revenue rose 21% to $378 million, while underlying EBITDA was $226 million, resulting in an EBITDA margin of 60%. The company's Nova operation drove group cash flow from continuing operations to $204 million, with its production and cash costs outperforming guidance. Chief Executive Peter Bradford said across the lithium joint venture, we saw a number of exciting developments. At Greenbushes, production increased as a result of the contribution of chemical grade plant 2, and in parallel, construction for the tailings retreatment plant neared completion and detailed engineering design has advanced for chemical grade plant 3. The materials sector came under pressure, though, with heavyweights Rio Tinto dropping 1.9% to 111.56 and BHP Billiton falling 1.2% to 46.35. Rival Fortescue Metal Group, however, bounced 2.2% to 19.87, ending 5 sessions of losses. Woodside shares gained 0.9% to 25.07 as oil prices rose more than 1%, near 7-year highs, which hit last week. Prices are supported by strong demand, tight supply, and heightened geopolitical risk, now analysts wrote in a note. And in fact, US government data showed that gasoline demand is just 4% below the pre-pandemic levels in 2019. Prices are on track for their biggest monthly gain in almost a year. Shares in the financial sector shed 1.8%, but tech companies were the clear outperformers of the session, with the sector rising 3.7%. Software company Xero rose 2.8% to 112.91, having bounced from a 2-year low touched last week. Afterpay's parent Block jumped 8.1% to 161.41, its biggest one-day gain since it began trading on January the 20th, but is still lower than its opening price of 176.63. RBA data released on Monday showed credit expanded at a brisk pace during the second half of 2021, lifting annual growth to a 13-year high as businesses could access loans during the lockdown. Credit expanded 7.2% in the calendar year 2021, well above the anemic 1.7% the year earlier. Investors are also keen to see the Australian Bureau of Statistics December retail report released today as a further gauge to the economy's strength. So, some better news at one level, but also some concerning news insofar that some of the recent positive moves in the market may well go into reverse quickly if there is more bad news out there. We are still in volatile and uncertain times. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.